This is the moment you've all been waiting for. Simon Popple, who talks gold, is back with me at a time when not just gold, but all metals are pretty much near all-time highs or at all-time highs. Welcome back. What a year so far.
So far is the key there, because I don't think we're anywhere near the top of this roller coaster. I think we could have a long way to go, so I think it's very exciting times.
I mean, gold. We had lots of key people in, including Peter Hamber as well, and he was calling 5K by about November this year. But look at it right now. We're already, breached the 4,800 mark. How much further have we got to go? I mean, could we see 5K in the next few weeks?
I think the direction of travel is clearly up, and I think all the big names are saying gold price higher. Speed of travel is less clear, but gold could really surprise people, because I think one of the things that people need to be aware of with gold is, because it doesn't yield anything, a lot of the conventional methods of valuation aren't relevant, like discounted cash flow, price earnings, all that kind of stuff. It doesn't make any sense. And what will happen is, or what could happen, is that, people compare the gold price today with the gold price it was last year, and they go, wow, it's overpriced. Mm-hmm. But my argument was it was ridiculously cheap then, and it's still, I still think there's a lot of value in it today, because I think it could go a lot higher. How much higher? I don't know. But I think you just need to focus on the direction of travel, and you need to be very careful, because we're in a new world.
Yes, that's right. And the thing I find fascinating about this space, and friends, you would have seen this too if you have been following this closely as I have the last 12 months. In a normal world, you would have sort of like, a stop that takes out half your position. Now I'm finding that you want to be in the game longer. So half might not be the right place to put it. I've been putting, quarter. Is that still too much?
Yeah, I like about an eighth. And I think you need to be very careful, because you could have a stop in and
get taken out.
It can get taken out during the day, and gold is volatile, silver is incredibly volatile. And what you could find is, gold goes up 5% on the day, and you think that's fantastic, but then you got stopped out because it went down 2% before it went up 5%. And so you need to be really, really careful. And I think the other point is, it's quite difficult to invest at these levels if you're not already invested. A lot of people are like, oh no, the price is way too high. And so it's a bit like property was many years ago. People sitting on the sidelines, and they're going to miss the boat. The boat's, it's still there. It's not too late now, but if they're not careful, they'll miss it. And if you've already got a position, let's say you're already up 30%, doesn't matter if you buy a bit more.
Yes.
But if you haven't got anything in,
and you're trying to jump in now,
now, it's more of a gulp. Can you do it? Yes, of course you can do it. But I think if we end up with 5,000-6,000 gold, there'll be a lot of people who haven't invested, and that is quite a brave move to enter the market at that level without any existing positions.
Now, we've got a lot of brave and also cautious and cautiously brave investors listening in. Goldman, they watch Goldman Sachs and Morgan Stanley as well. I think Goldman recently upgraded their forecast to 5,400 by year end. Yeah. Is that still an underestimate, do you think? They're not the only ones. The other houses have also done so. But is there still an underestimate, do you think?
I personally think it could go higher. I think the direction of travel, as I said earlier, is very clear. Where it gets to by the end of the year, it'd be no surprise to me if, we're only in January and they've already revised it. It'd be no surprise to me if they end up revising it again. Because it could go a lot higher. I think this is where it's particularly difficult for charters, because they probably look at where it is now, and as you say, all-time highs. And
I'm finding it very difficult.
Well, exactly. Yeah, psychologically, it's difficult. You don't want to buy high, sell low, and but if you can get in now, then I think the same applies, funnily enough, for getting into a market as getting out of a market. So if you're uncomfortable because you think the price is really high, don't just put all your money in today. Put a chunk in today. If it continues to go up, you've already made a bit of a profit, so you're sort of more confident about putting a bit more money in. If it goes down, then you can put a bit more money in at a discount. But yeah, just build your position. And I think that's where people need to be a little bit careful, because you want to build your position in and build your position out. And if the market does, if it really, really does go ballistic, then doing that could be, very healthy, because you put some money, more and more money on the table, you take less and less money off the table. And even if there's a blowout at the end, providing you've got some money on the table, you've either made an awful lot of money over the investment period, and the fact that you ended up losing on your last piece doesn't really matter, or your last piece may go to the moon. We don't know, but if it does, you're still happy.
Yeah. And actually, position sizing is probably one of the most important things in times like this. Here's a great example for you. Greatland Resources earlier today. So it had that big drop earlier on, which hasn't been seen for many, many sessions. This, to me, was an opportunity to jump in because I've done my due diligence on the company, and I bought a chunk there, and as you can see, it's starting to have institutional investors, the smart money, come back in, and it's now coming back up again. This is the 5-minute chart showing you the 4 hourly, so you can see a bit of a view there, and the daily as well, to show you its trajectory, and it's still in a positive, strong uptrend there. Speaking of miners, you're focused very much on producers, and you think this is where the sparkle is.
Yeah, I mean, I think there's sparkle on both, but the producers typically will lag the gold price. And what could be really exciting about the producers is when they start excuse the pun, producing results, delivering results. Yes, the cost base will go up. Let's say the cost base goes up by, 10%. But the gold price has been flying up. I don't know, it depends on sort of where you base it from. But, the gold price, let's say, has gone up 40%. That's a 30% increase in your margin. And not only is it a 30% increase in your margin, but it will mean that a lot of gold, when they actually calculate their reserves, they base it off what is economical to mine. And if your gold price is like 2,000, then there's a lot of gold, or you might have a lot of gold that's there that's not economical to mine. But if the price goes up to 4,000, so you have to dig an extra 200 meters, because it's at 4,000, you can afford to do it. And
I love it when you're so detailed about how deep you have to, how much deeper you have to dig.
But all I'm saying is it could, we don't know what's going to happen, because, we're not literally at the, I say the coal face, but at the gold face. But what you may find is some of these miners actually producing an awful lot of gold, but their reserves are not actually changing that dramatically, because they've actually been mining stuff that wasn't actually kind of in the books, but it just turns out the gold price is so high. Someone said, "Oh, why don't we have a crack at that? Gold price is whatever it is, 4,800. We can actually make a profit if we mine that."
By my calculations, Simon, I'm looking at you and slightly winking, because I'm hoping you're going to update my data. So a year or so ago, I calculated that the average cash cost for producing gold was about 1,200.
Yeah, it's probably more like about 1,400, 1,500 now. Mm-hmm. Again, that kind of doesn't really fit in with what we're told on the inflation front. Mm-hmm. That's quite a lot higher than the inflation number we're given.
I guess the question is, which one of these producers do you like in particular?
I like big gold producers that have got a lot of assets up and running, producing gold.
Proven.
I mean, like the big ones, you know, you've got, you don't have to be a rocket scientist to look at, you know, like the top 10 producers. You know, the top 10 producers would include people like, you know, Newmont, Wheaton Precious Metals, Barrick, you know, the really big boys. You know, they're producing a hell of a lot of gold. And if they're producing a lot of gold and they've got a lot of margin expansion, then logically the share prices should increase. So, you know, it could be very interesting.
How about the likes of Barrick, Sarabi, BHP?
Yeah, I mean, Barrick have got, I think that commodities are going to become very political, as we've seen with Greenland, where people are, you know, back in the day, when prices were cheap, they would be quite happy for a foreign company to come in and mine their stuff. Now, they're less keen. And you know, not only does Greenland have, obviously, defence ramifications for the US, but it's got a hell of a lot of natural resources. And I think they're becoming very important for countries. You know, if you're sitting on huge deposits of gold, copper, silver, whatever it is, and that's part of your country, and a lot of that money is basically going abroad. If the price is high, you're probably less concerned about it. But I think people are becoming a bit more territorial and going, actually, that silver is, you know, our silver and we want to keep it. And that's why you've got countries like Mali and I'm sure there's a few others who are sort of thinking, well, actually, you know, if we're going to let these people in to mine our natural resources, you know, we want to get you know, a slug of the action. And I think that's going to become more and more common over the next, you know, few years.
What's fascinating about Greenland as well is I've been looking at who has licenses already approved to mine there, and the minerals that are expected to be of interest to Trump is also another fascinating one. Have you ever heard of titanium vanadium?
I've heard of it, yeah.
It's so exciting. Someone on our client call has mentioned that, and that got me all excited on the train journey in. It's one of the few alpha beta materials that, what that actually just means very simply is that you add this material to any other metal and it instantly makes a stronger alloy.
Yeah, I mean, it's the thing about commodities is you can't print them. You know what I mean? If you say, I want some titanium, whatever, you can't just say, right, I'm buying titanium paper contracts. You need titanium. And I think this is, I'm not saying the reason, I think it's certainly one of the reasons why Greenland has become such a focal point, because you can get a lot of rare earths out of places like Greenland. I think the other thing that people need to be aware of is that to actually get these resources takes a hell of a long time.
Yeah, so like gold, I often try and reassess the you know, timing needed. It's still around like 5 years, north of 5 years, right?
Oh yeah.
And copper is another one that I'm watching, because copper by far it takes one of the longest.
Copper takes, first of all, it takes a long time. Secondly, you've got to raise an awful lot of money to build a copper processing plant. I mean, I think gold, you could probably build a mine and a processing plant with, you know, $200-300 million. A copper plant is more like $1 billion to $2 billion, and because of that, it needs to be large. And I think it's also worth pointing out that silver is a byproduct of copper. Now, it's a byproduct of gold and other metals as well. You get polymetallic ore, so silver could well be in that. But in terms of actually dealing with the silver crunch that we seem to have at the moment, one of the reasons I like producers is they're actually producing it. And so over the next few years, you would hope that they can fill some of the supply gap. Explorers, still fantastic, but going back to what we just said, you could be talking 5-10 years before they actually start producing silver or copper or whatever it is. And so because of that lag, that's where I'd expect to see a bit of a discount, because let's say the current situation does resolve itself and gold and silver go down to, let's say, more normal levels, whatever they are, then your explorers will be sort of producing in a market that is a lot more subdued than the current one. But the current one is hot. There's
no doubt
about that. And therefore, if you've got someone who's actually producing something in a hot market, then I think that it'd be no surprise to me if the share price goes up.
And for many of our viewers who are watching this, wanting to get a real sort of like reassurance, I suppose, because they've obviously seen prices continually, day after day, they keep getting higher. Yeah. We're not even talking about, as a chartist, we talk about how charts and price action never ever move in a straight line.
No.
But what I've been teaching my clients and my viewers as well is that watch for it and I use a term that only my kids understand, so it's easy for them. So I teach this to my clients as well, because if everyone understands, we're all winning, right?
Yeah.
And it's like a floating staircase. Every single day, the bulls are in such control that the price almost never meanders down. It's like a floating staircase.
Yeah, it's very. You need strong nerves to trade this market, because, in really simplistic terms, and this is incredibly simplistic, you have good days and bad days. And so if you see gold or silver shoot up, that's your good day. Now, then that's quite often followed by a bad day. But a bad day is not as bad as a good day, if you know what I mean.
Yes.
So you probably find, let's say it goes up 2% on a good day, it goes down 1% on a bad day, but then it goes up another 2%. So you kind of, I think most people, when they trade, they perhaps look on a daily basis. And this is quite difficult, because you kind of, it would help some people if they looked on, let's say, a 3-day basis.
Or a weekly.
Basis. Yeah. And so, what they're doing is they'll trade at this level, and then hopefully they've got it on a good day, so it'll go up. But if it goes down, then that's where it gets painful, because you kind of like, well, do I sell or do I stick it out? And I would say if you can afford to stick it out, then it might make sense to keep at least some of your money in play, because there's a chance it will go back up, and there's a good chance it will go back up.
And that's why position sizing matters, going in and coming out as well. For investors, they're asking, right, how long can this go on for? Are miners able to achieve that price when selling to their customer base?
Yeah, it's the price of gold is the price of gold. The spot price is the spot price, and can they achieve the price? Why would, if the gold price is this, why would they accept anything less than the price? Now, yes, there may be a slight discount because it has to be refined, and but if the gold price is going up, I don't think that they will be able to sell gold at a significant discount, because you only sell stuff at a significant discount if there's oversupply. And going back to what I view as the drivers of the gold price, which we talked about before, market uncertainty, bags of it, interest rates trending down, debt
going
flying
up.
Inflation. This week, they were talking about inflation increasing in the UK. I don't feel it's under control. And
is this the same story for silver? Because silver in the past year has been the star of the show.
I think silver is super volatile. That's
last year more volatile than Bitcoin.
Yeah, but performed a hell of a lot better than Bitcoin. And but I think that silver is very volatile. But what I love about silver is, if you think about the uses of silver, I mean, gold doesn't. Yes, it's got uses, but it's more of a kind of, I don't know, an asset, a finance asset. Silver, electric cars, solar panels, clean tech. It's got, the uses of silver is going up and up. Again, you can't print silver.
AI.
Yeah. And so I think silver, it had a good year last year. God knows what's going to happen this year, but so far this year, silver is flying, and there's a gold-silver ratio, and I know that a lot of people, it kind of messes with their head because I think the normal ratio is something like between 75 and 85, but historically it's been like 1 to 12, 1 to 16, something like that. And so what really messes with people's heads is that for silver to get to that level, either the gold price would have to absolutely crash, or if the gold price keeps going up, then silver is going to go up even more to sort of reduce that ratio.
So speaking of crash, we got to be balanced here. What scenarios is the Popple looking at that might say, you know what, this is a kicker. This is a change of thought, of regime.
It's really difficult because going back to the MIDI that we just discussed, I don't see the debt coming down. And if you think about the way the market has probably worked over the last 20 years, it used to be go up, crash, go up, crash, go up, crash. But politicians now have realised that you can print money. And if you print money, you kind of stop the crash. And if you stop the crash, then you're, I wouldn't say you're popular, but you're not unpopular. And
no one's been stopping that Kool-Aid. I mean, I worked through the great financial crisis. Everyone said, oh, well, after this, it's going to be something. It's not going to continue. The punch bowl is going to be taken away. And it has never been taken away.
Well, that's the problem. And because the punch bowl hasn't been taken away, more and more money has been printed. And there comes a tipping point, and no one knows where it is, where people are like, well, actually, I don't want to buy treasuries or whatever it is, because all they're going to do is print them. So there's no kind of like anchor to those. And I think that could be one of the reasons why more people are looking at things like gold and real assets. And so, there's a very kind of changing of the guard, so to speak. And I think that this is where some of your viewers will have to be very careful, because if you're looking at charts and trends and things like that, are they relevant? Of course they are. But you have to be very careful, because if you see a big spike up there, back in the day, you probably go, there's no way I'm investing at that level. But it might be that you do. But going back to what we said earlier, you're more careful about how you do it. You don't put all your money in, you put an eighth or a quarter or whatever it is, and see what happens.
Right. Thank you very much for all of that. Simon Popple from the Gold Program. You can find him on his website, and also if you look at our IG UK_official YouTube site once we drop it there. But for any comments, please put them below. Main thing from Simon, look at, he's looking at producers that produce a lot of gold, expanding margins as well. So keep an eye for that. If you like this content, we'll be bringing you more on IG Commodities Weekly. Whatever you're doing, may the odds be stacked in your favor.